There's a massive gap opening up between gold and silver that's screaming opportunity to those who know how to read it. Gold is sitting at $5,071 per ounce, while silver trades at just $77.62, creating a gold-to-silver ratio of 65-1. But here's what makes this absolutely critical right now. Behind these prices lies a financial crisis that's quietly intensifying, with U.S. household debt exploding to $18.8 trillion, credit card delinquencies hitting their worst levels since 2011, and 18 major companies filing bankruptcy in just 3 weeks. This is the exact environment where understanding the relationship between gold and silver can make or break your portfolio. Why is gold holding strong while silver crashed 40% from its peak? What does this divergence tell us about where both metals are headed next? And most importantly, which metal should you be buying right now to maximize your returns and protect your wealth? In the next several minutes, I'm going to reveal the hidden crisis driving these markets, decode what the price gap really means, and give you a clear action plan for positioning yourself ahead of what could be the biggest precious metals move of 2026. Welcome back to the channel, and if this is your first time watching, make sure you hit that subscribe button and turn on notifications, because we're covering critical market developments that could have a massive impact on your financial future. Today is February 13th, 2026. And we need to have a serious discussion about the enormous gap that's opened up between gold and silver prices, and what this divergence is telling us about the current state of precious metals markets and the broader economy. Let's start with the basic numbers that everyone can see, but most people don't truly understand. Gold is currently trading at $5,071 per ounce. This represents a remarkable achievement for the yellow metal, as it's holding well above the psychologically important $5,000 level despite enormous volatility over the past 2 weeks. If we look back just a couple of weeks, gold hit an all-time high near $5,600 per ounce before experiencing a sharp correction that took it down to around $4,400. The fact that gold has recovered to current levels and is showing strength tells us that underlying demand remains extremely robust. Now let's look at silver, which is trading at $77.62 per ounce. On the surface, this might seem like a respectable price, especially when you consider that silver was trading in the $20 to $30 range for much of the past decade. But when you understand what happened to silver recently, the current price tells a very different story. Silver reached an all-time high of $121.50 per ounce on January 29, 2026, which was an absolutely historic moment. For the first time ever, silver traded above $100, and the excitement among silver investors was electric. But then came the crash. Silver plunged 40% from that peak, falling as low as $71 before recovering to current levels around $77.62. So here's the critical question. Why did gold fall roughly 21% from its peak while silver crashed 40%? Why is silver showing so much more volatility and weakness compared to gold? The answer to these questions lies in understanding the fundamental differences between these two metals and how they respond to different market conditions. Gold is primarily a monetary metal and store of value. It's the ultimate safe haven asset that investors flock to during times of uncertainty, inflation fears, and financial system stress. Central banks around the world hold gold as a reserve asset. Wealthy individuals allocate to gold as portfolio insurance. Gold's value is largely driven by investment demand, jewelry consumption in markets like India and China, and its role as an alternative to fiat currencies. When people lose confidence in paper money, they buy gold. When geopolitical tensions rise, they buy gold. When inflation threatens their purchasing power, they buy gold. Silver, on the other hand, is a hybrid asset with dual personalities. Yes, it has monetary properties and serves as a store of value similar to gold. But more than 50% of silver demand comes from industrial applications. Silver is used in electronics, solar panels, medical devices, automotive systems, 5G telecommunications equipment, and countless other industrial products. This industrial component makes silver much more sensitive to economic growth expectations and business cycle dynamics. When the economy is growing and industrial production is expanding, silver demand increases. When recession fears emerge and manufacturing slows, silver demand weakens. This fundamental difference explains much of the divergence we're seeing. The recent crash in silver was triggered by the nomination of Kevin Warsh as the next Federal Reserve Chairman, which markets interpreted as a signal of tighter monetary policy ahead. Tighter monetary policy typically means higher interest rates, which can slow economic growth and reduce industrial demand for metals like silver. Additionally, higher interest rates strengthen the US dollar, which makes dollar-denominated commodities less attractive to international buyers. But there's another critical factor that explains the gold-silver price gap, and that's the role of leverage and speculation. Silver attracts far more speculative interest than gold because of its lower price point and higher volatility. Retail traders love silver because they can buy more ounces for the same amount of capital, and the percentage price swings are larger, creating opportunities for bigger gains. But this also means bigger losses when the market turns against them. In the weeks leading up to silver's peak above $121, speculative positioning had reached extreme levels. The commitment of traders' reports showed massive net long positions by large speculators. Social media was buzzing with silver enthusiasm. Retail trading platforms saw record volumes in silver-related products. This kind of crowded positioning is inherently unstable, and when the selling started, it became a stampede. Now let me pull back the curtain and show you the deeper crisis that's creating the foundation for what's happening in precious metals markets right now. While everyone is focused on daily price movements and technical charts, there's a much bigger story unfolding that explains why both gold and silver are in long-term bull markets despite the recent volatility, and why the gap between them creates opportunity rather than concern. The United States is sitting on a financial powder keg that most mainstream media outlets are either ignoring or downplaying. According to the latest data from the New York Federal Reserve, total household debt has reached an absolutely staggering $18.8 trillion. Let me put that number in perspective for you. That's more than the entire GDP of China, the world's second largest economy. It's roughly equivalent to the combined GDP of Germany, Japan, and the United Kingdom. And it's growing at an accelerating pace with no sign of slowing down. This $18.8 trillion includes mortgages, which make up the largest component, but also auto loans, credit card balances, student loans, and other forms of consumer debt. Every single category is at or near all-time highs. But here's what makes this truly alarming. It's not just the total amount of debt that's the problem. It's the ability of borrowers to service that debt and the increasing signs of stress that are appearing across the system. Credit card delinquencies have climbed to 12.7% in the fourth quarter of 2025. This is the highest level we've seen since 2011 in the aftermath of the financial crisis. What this means is that more than 1 out of every 8 credit card accounts is seriously delinquent, meaning the borrower is more than 90 days behind on payments. When you have delinquency rates this high, it signals that a significant portion of the population is struggling to meet their basic financial obligations. They're not missing payments because they forgot or because it's convenient. They're missing payments because they literally don't have the money. The stress is particularly acute among younger households. Millennials and Gen Z borrowers are showing delinquency rates that are significantly higher than older cohorts. These are people who are supposed to be in their prime earning years, building wealth, starting families, buying homes. Instead, they're drowning in debt from student loans, auto financing, and credit cards, with wages that haven't kept pace with the cost of living. But the household debt crisis is only one piece of the puzzle. On the corporate side, we're seeing equally troubling developments. Over the past 3 weeks alone, 18 U.S. companies with liabilities exceeding $50 million have filed for bankruptcy protection. 18 companies in 3 weeks. This is the fastest pace of corporate bankruptcies we've seen since the COVID pandemic, and we're approaching levels that were last witnessed during the 2009 financial crisis at the depths of the Great Recession. These aren't small mom-and-pop businesses we're talking about. These are significant companies with substantial debt loads, hundreds or thousands of employees, complex supply chains, and in many cases, publicly traded bonds held by pension funds, insurance companies, and retail investors. When companies of this size go bankrupt, the ripple effects spread throughout the economy. Employees lose their jobs and stop spending. Suppliers don't get paid and face their own financial stress. Bondholders take losses that reduce their ability to make new investments. It's a vicious cycle that feeds on itself. Now here's where this connects directly to gold and silver. When you have this level of financial stress building in the system, central banks and governments have very limited options for how to respond. They can either allow the debt defaults and bankruptcies to run their course, which would cause a deflationary depression and massive unemployment, or they can intervene with monetary and fiscal stimulus to prevent the worst outcomes. History shows us very clearly which path they choose every single time. They print money, they cut interest rates, they bail out failing institutions, they run enormous budget deficits funded by central bank bond purchases. This is exactly what happened in 2008 during the financial crisis. It's what happened in 2020 during the pandemic. And it's what will happen again when the current crisis reaches a critical point. The Federal Reserve talks tough about fighting inflation and maintaining price stability, but when faced with a choice between letting the financial system implode or printing more money, they will choose the printing press every single time. They have no choice. The alternative is politically and economically unacceptable. And this is why gold and silver are in long-term bull markets, regardless of short-term volatility. When central banks print money to solve debt crises, the value of that money declines relative to hard assets. Now let's dive into the technical relationship between gold and silver and what it's telling us about potential trading and investment opportunities right now. The gold-to-silver ratio is one of the most important metrics in precious metals investing, and understanding how to interpret it can give you a significant edge in timing your entries and exits in these markets. The gold-to-silver ratio is calculated by simply dividing the price of gold by the price of silver. With gold at $5,071 and silver at $77.62, the current ratio is approximately 65.3 to 1. This means it takes 65.3 ounces of silver to equal the value of 1 ounce of gold. But this ratio is not static. It fluctuates constantly based on the relative performance of the two metals. And these fluctuations create opportunities for sophisticated investors who understand the patterns. Let's look at some historical context to understand where we are right now. Over the past century, the gold-to-silver ratio has ranged from as low as 15 to 1 to as high as 120 to 1. The long-term average across different time periods tends to fall somewhere between 50 to 1 and 60 to 1, depending on which time frame you examine. In recent years, we've seen the ratio swing dramatically based on market conditions. During the March 2020 COVID pandemic panic, the ratio spiked to nearly 125 to 1 as investors fled to gold and sold silver. This represented an extreme flight to safety, where the monetary properties of gold were valued far more highly than the industrial applications of silver. But as economic recovery took hold and industrial production rebounded, the ratio compressed dramatically, falling below 70 to 1 by the end of 2020 and continuing to trend lower in subsequent years. Just 2 weeks ago, when silver hit its all-time high above $121 and gold was near $5,600, the ratio had compressed to approximately 46 to 1. This was the lowest reading we'd seen since 2012 and represented a situation where silver was extremely expensive relative to gold. What happened next was textbook ratio mean reversion. Silver crashed 40% while gold fell only 21%. and the ratio widened back out to current levels around 65 to 1. So what does the current ratio of 65 to 1 tell us about potential opportunities? There are several ways to interpret this. First, from a historical perspective, 65 to 1 is slightly above the long-term average, but not at an extreme level. It's neither screaming that silver is massively undervalued, nor that it's dramatically overvalued. It's in what we might call the neutral zone, where either metal could outperform depending on how market conditions evolve. However, if we dig deeper into the fundamentals, there's a strong case to be made that silver is undervalued at current ratio levels. Remember the supply deficit story we've discussed. The silver market has been in deficit for 6 consecutive years, with demand exceeding supply by approximately 80 to 100 million ounces annually. Gold, by contrast, typically runs a much smaller deficit or even a slight surplus in some years. When one market has a persistent structural deficit and the other doesn't, basic economics tells us that the deficit market should see greater price appreciation over time. Industrial demand trends also favor silver compression. The megatrends driving silver consumption, including artificial intelligence infrastructure, 5G deployment, electric vehicle adoption, and renewable energy expansion, are all accelerating. These are not cyclical trends that will reverse in a recession. They are structural, multi-decade shifts in how the global economy operates. Gold doesn't benefit from these trends in the same way because it has minimal industrial applications. From a trading perspective, the current ratio creates interesting opportunities for tactical positioning. If you believe, as I do, that the ratio will compress back towards 55 to 1 or 50 to 1 over the coming months, then silver will need to outperform gold by a significant margin. At a 50 to 1 ratio with gold at $5,071, silver would need to be at 101.42s. That represents a 30.7% gain in silver versus gold remaining flat. If gold also rises during this period, silver's absolute gains would be even larger. Some sophisticated investors use ratio movements to make rotation decisions between the two metals. When the ratio is very high, say above 80 to 1, they rotate from gold into silver, betting on mean reversion. When the ratio is very low, say below 50 to 1, they rotate from silver back into gold to lock in gains. This strategy has worked remarkably well over long time periods. So after examining the price gap between gold and silver, understanding the underlying financial crisis, and analyzing the technical ratio dynamics, we arrive at the critical question that determines whether you make money or lose money in this market. Which metal should you be buying right now, gold or silver? And how should you structure your precious metals portfolio to maximize returns while managing risk? Let me give you a clear, actionable strategy based on everything we've covered. First, let's establish a fundamental principle that should guide all of your precious metals investing decisions. Both gold and silver belong in a well-diversified portfolio as insurance against currency debasement, inflation, and financial system instability. This is not an either-or decision where you have to choose one metal and ignore the other. The optimal approach for most investors is to hold both metals in proportions that reflect your risk tolerance, investment timeline, and conviction about various market scenarios. That said, the current market environment creates a compelling case for overweighting silver relative to gold for investors who can tolerate higher volatility. Here's my reasoning. Silver has corrected 40% from its peak, while gold has fallen only 21%. This means silver is now closer to potential value levels while still maintaining the same fundamental drivers that took it to all-time highs in the first place. The supply deficit hasn't gone away. Industrial demand hasn't collapsed. Investment interest, while dampened by the crash, is recovering as investors recognize the buying opportunity. The gold-to-silver ratio at 65 to 1 provides meaningful upside potential if we see ratio compression back towards historical norms around 50 to 1. If you buy silver at current levels and the ratio compresses while both metals rise, you get a double benefit. You profit from the absolute price appreciation in silver, plus you profit from silver outperforming gold on a relative basis. This is how you generate outsized returns in precious metals markets. However, I want to be very clear about the risk profile of this strategy. Silver is significantly more volatile than gold. We just watched it fall 40% in a matter of days. It could absolutely fall another 20% or 30% from current levels if we get another wave of selling or negative macroeconomic surprises. If that level of volatility would cause you to panic and sell at the worst possible time, then you should not be overweight silver. You should stick with a more conservative allocation that favors gold. For most investors, I recommend a precious metals allocation that looks something like this. Start with 10% to 15% of your total investment portfolio in precious metals. This is enough to provide meaningful protection and upside if metals continue their bull market, but not so much that a severe correction would devastate your overall wealth. Within that precious metals allocation, consider a 60% gold and 40% silver split. This gives you the stability and safe haven characteristics of gold, while also capturing the higher upside potential of silver. If you're more aggressive and have higher risk tolerance, you could shift that to 40% gold and 60% silver, or even 30% gold and 70% silver. But I would caution against going 100% silver unless you're a very active trader who can manage the volatility through disciplined risk management and position sizing. In terms of specific implementation, there are multiple ways to gain exposure to both metals. Physical ownership of coins and bars provides the highest level of security and eliminates counterparty risk, but you need to deal with storage and insurance considerations. For Indian investors, MCX futures offer leverage and liquidity, but require careful margin management. Internationally, ETFs like GLD for gold and SLV for silver provide convenient exposure with stock market liquidity. Timing-wise, I believe the current levels present attractive entry points for both metals, with silver being particularly compelling given the magnitude of its recent correction. Rather than trying to time a perfect bottom, which is essentially impossible, I recommend using a dollar-cost averaging approach. Invest 1/3 of your intended allocation now, another third if prices fall 10% from here, and the final third if they fall another 10% beyond that. The key is to have conviction in the long-term thesis while remaining flexible and disciplined in your execution. The financial crisis we've discussed, with record household debt, rising delinquencies, accelerating corporate bankruptcies, and inevitable central bank response through monetary expansion, creates a multi-year tailwind for precious metals. Short-term volatility is the price you pay for long-term outperformance. If you found this analysis valuable, please hit that like button and subscribe for daily precious metals market updates. Comment below and let me know your allocation between gold and silver. Until next time, invest wisely and protect your wealth.